Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is a hedge fund manager at Crescott Capital. And in my opinion, he puts out some of the best, if not the best, free charts available on a lot of different topics. He is one of the all-stars of financial Twitter. Tavi Costa, thank you for joining me again.
Jason, thanks for having me. Thanks for the introduction, and look forward to talking to you as well.
Now, today is January 29th, 2021, before people ask, because people always ask about the date when we're recording these interviews. And as usual, things are bipolar and crazy in the markets. But I want to get your opinion on one of the charts that you recently put out. So you put out something very interesting in the last month or so about how large central bank balance sheets increased in 2020. They increased, according to your research, by 9.2 trillion net in 2020. Do you think that that number only goes higher in 2021? And will most of that increase be from the Federal Reserve?
Yes, I do. I think we're especially fiscal profligacy is here to stay, and that's on the fiscal side. But the monetary side is likely to be the one funding this. We had an increase of about $4 trillion of public debt since the beginning of January. And what we're seeing now is somewhere close to 70% of that amount was basically funded by the Federal Reserve and U.S. banks. The majority was obviously by the Federal Reserve, and a portion of that was through U.S. banks as well. And I think this is here to stay. I think the government has done a major transfer of wealth from the government to the people. And by that, I mean, if you look at the bottom 50%, of the U.S. population, if you looked at almost any other, financial classes here in the U.S., clearly you can see that there was a transfer of wealth of about $11.8 trillion since the beginning of the recession here in the U.S. back in 2020, as we are still in a recession. And for me, the government cannot afford this party, as I call, to stop, and won't let it stop. And I think in terms of the fiscal and monetary mix of policies that we're seeing today are completely different than what we saw during prior recessions. It's having a very different social and economic impact in the economy. And so I think this is going to continue until we see inflationary forces. The more deflationary forces we see, the more money printing we're going to see probably. And that, that goes back to money printing, the whole discussion and debate about is QE money printing. That for me is a total waste of time of any investor. That's monetary dilution at the end of the day. What we're seeing, and it's probably likely to continue for the following months or so. It's such an important part of our thesis as we are very long hard assets, and for that I'm specifically talking about commodities and especially gold and silver. And for us, finding properties with gold and silver underground is really where the opportunity is for the following months and years. So if that answers your question, I really think that the twin deficits issue is just adding to the problem. Obviously, we have fiscal, on the fiscal deficit side, we're close to World War II levels. We have the current account side that is in the trade balance, which is the majority of that, is at the lowest level since 2006. That whole thing just adds to the debt pile that we're seeing in the government side, and I think that's only going to continue. And I think that the bottom 50% becoming wealthier in nominal terms, but also somewhat adjusted for inflation, even though it's massively understated by the government. At the end of the day, I think it's going to continue to drive standard of living prices to higher levels, and that's going to have inflationary forces along with a major shortage of supply of commodities that are likely to hit the market in the following years too.
I put out a video a few hours ago about going through Ben Bernanke's 2010 op-ed from the Washington Post. And he was talking about quantitative easing and how it was unconventional at the time talking about inflating asset prices, keeping asset prices up, not allowing deflation. They will do whatever it takes to fight deflation. One of their main goals was to not allow deflation, not allow the CPI to fall, but to boost asset prices. But now we're starting to see the money supply, M1, M2, they're exploding. Ben Bernanke in that 2010 op-ed was warning at the time in 2010 that that would not happen with the quantitative easing programs. And yet here we are, we're starting to see what Ben Bernanke said would be inflationary in 2010. We're starting to see M1, M2 explode. But what's kind of interesting, Tavi, is that the Fed's official balance sheet, these budget deficits you talked about, and what we're at 75-year records or near records as a percentage of GDP with the budget deficits. The US has to run trade deficits because of the world reserve currency. They really can't run large trade surpluses being the world reserve currency. But with the record budget deficits, we haven't seen, I think in the last 6 or so months, we haven't seen a big increase in the Fed's balance sheet. So you expect that to change then, because the Fed's balance sheet as of right now is only around 7.4 trillion when we're recording this interview, but the national debt, Tavi, is increasing at an increasing rate. We're almost at 28 trillion now, and Joe Biden and a slightly Democrat Congress, they're talking about sending out what the $600 debit cards are not out to everyone yet, and they're already talking about the next round. And then they're talking about forgiving mortgages or rent, and then $2,000 checks or debit cards. So they're already talking about just trillions more in spending, and there's a long list of things that they want to spend. And the government tax revenues, I think this is important that most people miss, is those tax revenues have not come back to pre-pandemic levels yet.
A lot of points to unpack. I'll start with your first one, which was regarding the deflationary forces that Ben Bernanke was worried about back post the global financial crisis. I think an important point to look here is the net worth of the U.S. bottom 50% at that time declined by about 84%. Okay, this time around, we saw the largest annual increase ever for the bottom 50%. So I think that's a huge difference. You know, if you look at the net worth is about 77% higher than it was at the peak of the housing bubble today. So, and rising. Okay. So I think that's, I think the deflationary forces, there are some that are certainly important to look at, but it's a bit overstated. The point about the current account deficit issue here in the US that it has to, given its reserve currency status. I think that the whole thing, all fiat currencies are in a race to the bottom, but I think the dollar is fundamentally stronger than any other currency in the world today. And I've said this before, it doesn't mean that I'm long hard assets and commodities, that I'm actually bearish on the dollar. We actually have very long positions in the dollar here at Crasket. So what we're seeing is you know, the issue with the debt is a very big deal. Government debt is increasing at a pace that we have never seen before. When you look at nominal terms, even all the way back to the 70s versus units of GDP, we're seeing an increase in units of debt that really is unprecedented. And I think that that's going to continue to translate into a growth in prices of assets that are tangible. In the case here would be commodities. And a lot of people were saying, well, low rates are great. And, you know, when you service that debt, it's actually really cheap right now. But the whole reason why servicing or debt service ratios are low, it's not because rates are low. I mean, yes, that is one part of it. But the second part of it is that the debt is increasing in such an enormous pace that it is also causing the ratio to decline in a huge way. I think that the Federal Reserve clearly has a mandate. And when you ask me, you know, do you think that the Federal Reserve will continue to print money, will continue to expand its balance sheet, whatever term you would like to use? It has a mandate of suppressing interest rates. It has a mandate of actually buying treasuries, essentially, to drive rates lower and allow the government and become a funding tool for the government to allow it to actually have the level of indebtedness that it does today. So I think that's the bottom line, is that as the debt continues to increase, we'll likely see a pickup from the Federal Reserve to actually buy those amounts of treasuries being issued. We had the largest issuance of notes and bonds ever here in November and December. And I think, that's all product of the amount of the deficit here that is almost it almost has to stay there, given how depressed the economy is. It's not to say that the net worth of individuals is improving because of a booming economy. This is not the case at all. We have issues with 18 plus million people still claiming some sort of unemployment benefit, insurance benefits. We have problems with corporations, still with profits still are declining in a big way, especially in the small cap space. And so, economic activity is still well below its historical average. Industrial capacity is doing the same. And I urge people to read what happened in post 1919 after the Spanish flu. I've said this before. That was a massive, because of the pandemic worldwide, industrial, especially actually raw materials became rare, and it caused a surge in prices of commodities at that time. It was not because of aggregate demand. It was because of supply. It was a lack of supply glut that really caused this rising hard assets at the time that accelerated the inflationary problem. And when people ask me, well, no, I don't disagree that the equity market is overvalued. The equity market is overvalued, but what changes? When valuations begin to matter? Well, valuations begin to matter when you have inflation rising, and that changes the cost of capital, changes the dynamic how you price risky assets, and that dynamic is usually with prices being priced lower, not higher, because of a cost of capital beginning to go up. And I think it all goes back to the inflationary forces that are not so much intended, and I completely ignore by the Federal Reserve today in a way that almost it's shocking to see or to hear some of the comments that we hear from the Federal Reserve about inflation. So I think we are in a scenario where that whole thesis of buy gold and sell stocks that have partially worked in 2020, it has never been more relevant today, and will probably continue to work, but perhaps in the two parts of the leg of that trade.
The 1919 pandemic you're referring to was around World War I as well, and during World War I, we had all these governments, they abandoned, or they claimed it was only temporary. They temporarily abandoned the gold standard, and then they just printed enormous amounts of money. And what that led to, Tavi, so you had the real economy was not functioning properly during wartime. You have wage and price controls. You have the real economy. You have resources that are allocated for war things instead of producing goods and services that consumers want. Now we transition to what's happening now, and we're seeing all these governments and central banks create trillions of new currency and credit units. And what worries me is the real economy is not producing nearly as many goods as it was before the pandemic. So there's all these trillions, new trillions of currency and credit chasing fewer goods and services, and eventually that's going to be inflationary. Now, I don't think government statistics like velocity of money and consumer prices are going to cover all this, but it's just common sense that if you create more, it's supply and demand. If you create more currency and credit and there's fewer goods, you're going to start to see just crazy behavior like what happened in Weimar Republic, how their economy was not doing well during periods and they were printing money. And then there was desperation for income and enormous speculation for foreign currency and stocks. You've seen that in hyperinflationary events in Zimbabwe and Venezuela, where their stock market goes up. And you were seeing it now with this just crazy speculative behavior. I'm seeing people post on my Facebook who are not in the financial industry. I didn't even know they have a business background. And they're bragging, these are regular people, how easy it is to make money trading cryptocurrency and stocks and call options, thousands of dollars per week or per month. It's just insane how things have gotten to this point.
Yeah, going back to your commodity point, it's an important part because it is a different environment than we saw in the World War One times, and I think that what we have today is a lack of spending in infrastructure, and the capex cycle for a lot of markets in the commodity space have been plunging, while some of those commodity prices have began to rise. Gold at basically all-time highs, very close to it. While you look at a lot of the of the gold producers are actually their capex in aggregate terms is actually diverging from metal prices. We had silver going up 50% in 2020, while silver producers, which is not something easy to measure, but silver producers actually had a decline of 20+% in their capex as well. So commodities is a major reason why, in my view, we have not seen inflation in the last 10 plus years. And I know some people like to say, well, we did see inflation. Asset prices began to rise, and we have, the price of rents were rising as well. We have perhaps some niches in grocery store pricings and so forth. But that's not what I'm referring to. I'm referring to the consumer prices, a type of acceleration that we see in places like emerging markets. We have not had this in the U.S., and I can assure you, because I've seen that in Brazil. And I think that the reason for that is because the Brazilian real or any other emerging market currency, when that begins to collapse or have issues, what you start to see is that the devaluation of currencies causes the hard assets in general to rise, and with that you start seeing inflationary forces picking up. I think that's what's going to happen here in the U.S. The same way it happened in the 70s, the same way it happened right prior to the 1920s. And during that time, by the way, it was an inflationary bust. The 1919 was when inflation began to rise. Everyone talking about the roaring 20s. Well, before the roaring 20s, there was a significant decline in equity markets of 40+% that really happened before we saw the roaring 20s. That's not the case here. We're at record valuations, while with an incredible amount of retail investors participating. You tell me, when was the last time we saw this level of participating, of level of involvement of retail investors, and that did not end up well. I really think that it's or did not end up badly. I really think that that's the case here. And unfortunately, a lot of people are seeing this as the beginning of a party, when it really feels a lot like the end of a party. To me. And at Crescat, we have added to our short positions. We have to change a little bit of the way we are doing the portfolio. We're constructing the portfolio rather than individual names. We have been picking more broad stocks. You see the volume of in equity markets today. It's astonishing. We've never seen anything like this. So I think a lot of people paying attention to the GameStop story and some other stories with Wall Street bets and all that are missing the big picture of the level of financial risk that there is in the markets today. And unfortunately, it looks like those folks, the bottom 50%, a lot of those guys are going to end up holding the bag one more time. They're clearly trying to do that. So that is the issue. I wish they would see the opportunity in silver, for instance. Why waste your time with AMC and GME or stocks in general, or even even gold per se, or even Bitcoin, when you have silver still trading below $30 an ounce, which is probably the cheapest inflation hedge you can find out there. It really is the roadmap or the highway to go from the old economy to the new economy. And in my view, there's so many opportunities to buy low and sell high, rather than buy high and try to sell it higher. Someone is going to be holding this bag at the end of the game, and I'm not sure. I think hedge funds are being seen as bad actors, and they have been. A lot of them. We are a hedge fund. Certainly had not been involved with a lot of the things that we hear out there. But certainly speaking for the industry, certainly that has been the case. And I think that was sort of overdue. I never thought that that would be the catalyst for things like silver, but perhaps that's it. A lot of times it's a unique catalyst that really creates a bull market for things like precious metals. And we have all the macro, we have all the fundamentals checked. We just need a catalyst, and perhaps that this is the catalyst that we are waiting for.
With all the free charts you've been putting out for years, I think you give away more than any hedge fund manager I've ever met.
We try to.
Yeah, so you have your free newsletter that you put out quarterly, which just came out on January 28th, yesterday. And then you have all these charts that are excellent. So, I mean, most hedge fund managers, it's trade secrets. They don't want to, a lot of them don't want to do a lot of public interviews. They don't want to release a lot of these things for free. You have hedge fund managers fighting releases of their newsletters publicly that don't want the stuff out there in the public domain.
Yeah, it is really, an issue. When you have the top 1% really owning about 15 times what the bottom 50% owns in financial assets. And when you break down, really the bottom 50% owns so much of real estate relative to their overall assets, that is not comparable with the top 1% that owns mostly financial assets. I think 80+% of their assets is financial assets, and those are the ones that really benefit from the policies that we're seeing. And perhaps a lot of the retail investors, and I keep saying retail investors, the bottom 50%, but even though there are retail investors that are in the higher financial classes category, but what I'm trying to say is that unfortunately they're coming in with I think the wrong strategy. They're buying up names that are already hyped and overvalued at this point. And when you can send a clear message doing other things, perhaps that make a lot more sense. But I'm not going to be the one, unfortunately, changing that. I've done my job, and we'll see. But I think the Nirvana trade, that the OG of all those trades, really is silver, and the precious metal space is still trading 4 times less than Apple's market cap. The whole industry trades 4 times less than Apple's market cap. You look on a free cash flow basis, you can see clearly that finally those miners are beginning to make money, are starting to make money, and which is something that we haven't seen in the last 25 years or so. They have been rightly so capital destroyers. That reputation was correct. They really lost money for over 2 or 3 decades, and so I think that what we're about to see here is a shift of capital flows towards this industry that is so unloved at the moment.
And the gold miners have good valuations, and you're getting paid to wait. With a company like Newmont Mining, 2.5% dividend yield, very little debt on their balance sheet. It's a solid company, and you're getting paid a very reasonable dividend yield. With a lot of these larger cap companies that have similar dividend yields, they have a lot of debt on their balance sheet in other industries. So in order to maintain that dividend, especially with a lot of these consumer companies where their sales are down, their balance sheets are heavily leveraged. So a lot of people aren't talking about this, but a lot of these large corporations in other industries, they've added enormous amounts more debt. So they're just rolling over debt, and the amount of government debt and corporate debt is still growing. So even though interest rates are lower, a lot of these companies have not paid down debt, and yet the gold miners have. So I think the gold miners are in fantastic shape, even if the gold price goes a little bit lower, as long as the oil price doesn't rise too much. Margins are still at record highs, around $800 an ounce to $900 an ounce industry-wide for the gold miners. So, I mean, they can generate really good free cash flow. They can maintain their dividend. I think Newmont Mining says their dividend can be maintained at around $1,200 or $1,300 an ounce gold. So these companies, I think the argument, Tavi, is that I don't think these companies have ever been in better shape, not even in the 1970s.
Oh, I couldn't agree more. I think you hit the nail on the head. And unfortunately, the skepticism about this industry is absurd still, and it's a lack of homework, in my view. If you just look at the change in short-term and long-term debt in the industry, we just had the largest repayment of that, where 60% of the aggregate free cash flow across the top 50 miners was actually used to pay down debt. We haven't seen that in the history of the data which goes back even to the 90s on this. And so, free cash flow growth that we're seeing is better than any other time in history. The growth is somewhere close to 135%, and we haven't seen this since the 90s as well. That's we're talking about the fundamental side. The macro side, the macro imbalances create the demand. And then you have the other side of things, which is the supply part of it, where I was talking about the capex cycle diverging from metal prices. There's a lack of discoveries. We haven't seen any major gold discovery in the last 3 years. The same goes for silver. The same goes for copper. And so there's a lot of reasons to be long gold and silver. Exploration budget has been still also diverging from metal prices. And when you put it all together with the political environment today, you had a Democratic sweep, you had Janet Yellen coming back, you had the IMF calling for a great reset. You have what the Federal Reserve saying that they're not thinking to raise rates, unlimited QE. Which I think is very similar to the 1971 or so gold standard break of the gold standard. So it's crazy to say this, but I really think that at 27 trillion of public debt, we're only getting started.
Yeah, maybe when I release this interview, we'll be at 28 trillion. It's growing so quickly.
True.
A couple more weeks, there'll be an extra surprise, like $300 billion increase in the Fed's balance sheet, and we'll be at 28 trillion. That's how fast things are going. Who knows at this point? After the $1,400 debit cards or checks are out, I'm sure they're going to be arguing, oh, that's not enough, or it's time for Green New Deal, or it's time for new Biden care, which is similar to Obamacare. They're going to just all the different types of spending they want to fund, and there's less tax revenues coming in. So it seems you think then that the Federal Reserve is going to be the buyer of last resort for the treasuries because the foreigners are not recycling their trade surpluses like China and other countries did in the past. You're not seeing that in the data where these foreign governments are buying massive amounts of treasuries anymore.
Well, it's very possible, even though when you have rates, the rate differential being a big issue in terms of German bonds yielding much less than treasuries, then it creates somewhat of a demand for treasuries. But still the big picture, when you step back, is that the Federal Reserve is likely to pick up the slack here and really be the buyer of last resort of those treasuries. We're seeing clearly a change in the government to start issuing more long-term debt, from notes to bonds, and what you see there is an attempt to increase the average months of the duration of the debt, but it's pretty interesting, the amount of stimulus that we have done all the way to now, and supported by our equity and fundamental models and macro models. We're at the very peak of the business cycle. We are at this great disconnect that we like to say, euphoric, risky assets, clearly record valuations with depressed economic fundamentals, and also a lack of organic growth that is making it even more difficult to create economic activity. So it creates a dependency on this excessive fiscal stimulus that is funded by monetary stimulus, as I was referring to. And so, with the twin deficit, that only exacerbates the problem, and the government will continue to pile on more and more debt. So, at the same time, and I know it's a doom and gloom sort of message, but at the same time as you have, the supercharged environment where the Federal Reserve is forced to be the buyer of last resort, at the same time suppress rates lower and creating a great environment for gold and silver and hard assets, and commodities to equity ratios still at a 50-year low. So, I think investors will begin to seek assets that protect them against inflation and monetary dilution. And this will be a big shift in the narrative in the following years.
Do you think that the Fed's balance sheet is probably the best catalyst for a much higher gold price, or do you see other factors that are more important than a big increase in the Fed's balance sheet going to 8 trillion, 9 trillion, 10 trillion, that would affect the gold price in dollars?
Oh, I think it's all linked to the central bank's balance sheet assets increasing. But and as they increase that, you start seeing negative yielding bonds beginning to rise in terms of amount of them. That also creates another macro driver. You have real rates being a very significant one, where they are forced to suppress nominal rates, and by doing that, you start seeing inflation expectation rise to new levels, and it creates this divergence between the two, and you start seeing inflation or real rates begin to drop at levels that we could potentially see, such as -4 or 5%, as we saw back in the 70s, depending on how you calculate it. But the other part of gold as well is this sort of a risk parity exhaustion point that we have reached in terms of portfolios trying to allocate money into bonds and equities. And both of them are now at record valuations. At what point do you start seeing capital flowing out of those two asset classes and beginning to come into commodities, and especially gold and silver, that have been a significant part of large allocators' portfolios in the past, in the 70s, for instance, and now is a very small percentage. So there is so much room for alternatives of the monetary system, assets that serve as that, and certainly gold and silver and Bitcoin could also serve as that as well. And I think there's a lot of room for, on a flow perspective, from a macro imbalance perspective, from a supply problem perspective, and just looking at the industry as a whole. A lot of the producers, the large producers, if you look at the mine life as a whole for the top 20 producers, clearly is actually shortened significantly over the years. So we're likely to see a supply cliff in reserves, where those large producers are going to have to start looking for new deposits, gold and silver deposits, to really expand their production line. So I think there's so many cases for gold and silver, while alternatives for assets relative to gold. I mean, you look at where do you get yield today? You can't find an investment that yields more than inflation expectation. I mean, even corporate bonds today yield less than inflation expectation. So, good luck finding an equity or a stock that actually yields more than inflation expectation too. So it's a difficult job to find something that has a potential of return, such as hard assets like gold and silver. So for me, it becomes clear that there's an opportunity here ahead. I also think oil looks pretty mispriced. I think oil should be trading higher levels. It could be the thing that actually triggers higher, bigger issues with inflation in the following months. I'm a big believer of that. It's a small position for us to give you a sense of conviction, but I think oil has the opportunity to go from one of the worst assets of performing assets of 2020 to perhaps one of the best performing assets of 2021 at some point.
In past commodities bull markets, normally gold and silver are actually the first two commodities that start to really rally and get into the bull market and increase higher in percentage terms. The last 6 or so months, really since the first week of September, we've had gold just in a major correction. I would argue there was enormous paper price smashes and market manipulation. A lot of the producing gold miners, including Newmont Mining and others, are either negative over the last 12 months now, or they're flat around 0%. And some of the junior mining indexes are actually outperforming over the last 12 months a lot of the producing gold miners, despite the producing gold miners having far superior fundamentals. So do you think then that gold is going to catch up to these other commodity prices that have been outperforming then in the last 5 or 6 months then?
I do. And it's interesting because you're right. Gold and silver or especially gold is the one that leads the way. And then you start seeing the others, cyclical commodities, to also move along with it. And I think even in the gold market, if you break down the history of gold, and you start seeing how the cycle begins, it really starts with gold, and then as investors begin to really believe in investment thesis in precious metals, they begin to go up on the risk curve and start buying the silver. and also start bidding up some of the miners. And it's pretty normal to see, most of the market participants screening the most known companies, such as Barrick, Newmont. And that's not to say that those companies aren't great companies, but that is to say that there's an opportunity as you start going even higher up in the risk curve, and higher risk as well, as that proposed. So I think that it's for us at Crescat, we've actually found much more valuable opportunities in the exploration segment of the mining space. And that's just because of this supply cliff problem among the producers that I think was going to hit the market in the following years. And the best way to do this, in my view, is it's hard because it's a part of the market what requires a lot of geological expertise. So for us, partner with probably the smartest exploration geologists in the world today has been very helpful to search for those properties worldwide, and being able to seek the safe some safe jurisdictions, areas that are not, some other less safe, but they're not so much priced into the potential of the deposit. Everything will vary. We have even positions in Bolivia that we like a lot. And but clearly there is a problem in terms of a shortage of commodities going forward, especially with commodities like silver that will be used to electrify the world if we're going to go to that route, along with copper, obviously. So lots of opportunities in the commodity space. And answering your question, yeah, I think gold is just in a consolidating phase. It had a big move. And gold is that giant market. It doesn't move as much. You're not going to get rich by buying gold, but you can protect capital by buying gold. But gold moves other assets. As gold goes up, it begins to move other assets that are more volatile with more potential of returns. Those are the miners, those are the explorers, those even silver, platinum, and so forth. And I think that's for people looking up to a higher potential return, those are more of the opportunities. But it all ties back to gold, and it all ties back to the macro forces that really create a bull market cycle for commodities. And I think we're at the beginning of that.
Rare earth elements actually are a good way to play the electric vehicle and the electric vehicle movement, and what politicians are planning then with adding electric vehicle charging stations, maybe subsidies and tax credits for electric vehicles, trying to transition the economy. So that's something, and I've written articles on that in the past for my patrons, with companies like Neo Performance Materials, which has contracts with Honda, and they design a lot of the electric vehicle motors, and they make other specialized rare earth element. They do a lot of research and development, so they're not like a rare earth miner, but there's a couple rare earth miners. Although during the last commodities bull market, after the rare earth stocks went up, some of them went up hundreds of %. A lot of them collapsed and went bankrupt because they couldn't raise enough money to build out a mine, and China was playing all the games. But I want to ask you, since you're a hedge fund and you have a lot more resources than I do here at my little research shop, is there any way to track what commodities China is about to start buying, or commodities that they are about to stop buying? So do you track what China is about to start accumulating in terms of commodities, or what they're about to stop buying? Because China's not buying US Treasuries. So they're running trade surpluses. They're clearly buying a lot of commodities. Their gold imports just increased massively again in January, along with Indian gold imports. So we're starting to see that, and that should put a bottom in the gold price, with the imports surging again for gold in China and India.
Well, China is a black box, and nobody knows what they're actually doing with their capital. But there is still a shortage of dollars, or a need of dollars to continue to pursue an economic model that may, for me, it's a failing type of economic model to go forward, and will be proven that way. And it hasn't been proven yet because it has a closed capital account, and we haven't seen a normal devaluation and crisis to really reprice the value of the assets that some of those, a lot of those Chinese banks actually hold. On close to $40 trillion of banking assets in their financial system is really poised to have a complete write down of those values, and should have. Those are things that usually happen during recessions, but we have not had a real recession in China, so we have not had those issues just yet. State-owned companies, and they can control a lot of the issues, but it makes it harder to open up their economy and become a threat for the U.S. in terms of the reserve currency, in my view. To your question about commodities, no, it was always a hurdle for myself, and that is a real risk for the commodity space, is a severe devaluation of the Chinese yuan, which is very, very possible in my view for the next 3 years or so. I know I've been saying this for a while, and actually happened in 2015. But in 2019, certainly went the other way for us in that trade, and it didn't work out. But the precious metals more than offset those losses. It was such a small part of the portfolio, given how cheap it is to put that trade on and bet against the yuan and the Hong Kong dollar, DPAG, I guess. So for us, we continue to have a very negative position on China. It's we believe that it's smart for investors to buy hard assets relative to the most overvalued currencies in the world, and the Chinese currency certainly fits that category. Going back to you said about commodities and getting into a bubbly scenario. Yeah, there's no doubt that we're probably going to, like any other market, when you get to the late stages of the cycle, you start seeing really capital being misallocated and deployed in the wrong ways. And that's really when you start seeing the complete overvalue market with frauds and hyped business models. And certainly that's the case with the overall equity market today, not the case today with gold and silver stocks. That is not to say that there are not bad actors out there. I'm sure and I'm aware of some, but and we looked at over 2,000 companies in the mining space. About 95% of those are not worth our investment, to be honest. And the other 5% that we look at, 3% of that basically have a lot of ego, and we don't like to work with those. We want to be used as triggers to really help those companies to succeed, rather than the other way around. I think, hopefully I answer your question. I really don't know. I don't think anybody has the answer for what your question was regarding China. It really is a black box. You would think that China at some point, if things are a little better down there because of the dollar amount of that has been increased over time due to the current account surplus, but I think that's just so minor on the big scope of things of their banking and crediting balances that they have for so many years. And I think that there's a big risk of misguidance in terms of policies that can create big problems in China. And that's a place that we're not bullish at all. We're very bearish about the Chinese economy.
Yeah, the Chinese banking system's a mess. You mentioned 2015. They were close to having a banking system collapse, and they had to move a bunch of liquidity and money back and forth to do bailouts and change the rules. But a lot of the economic and political elites in China, they don't keep their money in the Chinese banking system. So they want to get a lot of their savings out of China, out of mainland China. They want it into other currencies like the dollar and the euro. They want to buy real estate all over the globe in other countries. And they've been doing that for the last 20 years or more. So follow what people do, follow the money, not what's going on with manipulated foreign exchange rates or bailouts in the banking system. Follow what the insiders are actually doing with their money. And that tells more of the truth, I think, than what's going on with China's currency right now.
Yeah, and it's pretty interesting what we're seeing in terms of sort of a crowded trade nowadays in an emerging market space. I kind of understand the idea. Obviously, it's the knock-on effect of commodities. If we're in a super cycle for commodities, I think emerging markets are going to do great, but that's not necessarily the case. I mean, emerging markets are already priced in to do great. The matter of fact, there's a major divergence between commodities and emerging markets. And it's funny to see, always have the same stories that emerging markets are actually going to emerge to become developed economies, but they never do. And calling China a developed economy is just, shame on anyone that says that. But I think that the way to, the real asymmetry here is really on the commodities space rather than emerging markets side. Why? Because emerging markets are also pricing in very overvalued currencies, and the Brazilian real being one of them that is really poised to continue to decline over time. I was calculating, for the last 10 years, there was only 1 or 2 years that the Brazilian real actually appreciated relative to the dollar. It's almost like a slam dunk that currency of emerging markets basically over time continue to devalue relative to the dollar, relative to gold, relative to almost any hard asset. And that is why you always have inflationary problems in emerging markets, especially places that have an open capital account, such as Brazil would be a good example of that. So anyways, I think that
isn't that the game plan though for a lot of these central bankers? It's a similar game plan or the exact same game plan from most of these central bankers in different countries is devalue the currency to boost exports.
Sure. And it's, for me, it's such a failing model that never works and never gets you as a developed economy. I don't know any developed economy that has done that in order to get to where they are today. So it is, I think you're better off focusing on innovation and other things rather than being a large exporter. And I wish Brazil would invest more in other things, but unfortunately it doesn't. But it does benefit from commodity prices, but also since it cannot develop their own products in Brazil, commodity prices end up affecting Brazil as well in an inflationary way, which is kind of counterintuitive if you think about it. You would think that commodity prices rising would just per se help the Brazilian economy, but it's not necessarily that way. It helps in by exporting those products, but also remember that they actually import a lot of their final products. So those final products that rise in prices as well, given whatever the issues with industrial capacity being limited worldwide, or just commodity prices actually rising, it all creates a bigger problem for them at the end of the day. So it is why you never see during a commodity super cycle an emerging market actually return back to actually become a developed economy, and they end up focusing too much on the exporting side of things. And then when commodity markets actually shift again, they end up not developing anything. So no, unfortunately, that's the case with most economies. And if you talk to most of the policymakers in Brazil, that is again what they're trying to do is to export their way out of it. And unfortunately, I don't think that that's the game plan.
And we saw this with the Arab Spring, where higher food prices and devalued currencies leak into the different supply chains, and they hurt the consumer, especially people who are poor or working class or middle class, because they use more of their income for food and healthcare, basic necessities to pay bills to survive, whereas more affluent people, they don't use the majority of their income for those things. So when commodity prices go up a lot, especially food prices, and when currencies get devalued, this starts to create massive amount of inflation that I don't think is covered in the government consumer price index. And 10 years ago, we saw this with the Arab Spring. Food prices increased substantially in a lot of these emerging markets, and there were riots and governments were overthrown. So we could see something similar in the not too distant future based on the cocktail of devalued currencies and higher commodity prices. And the other point you brought up was if the currency is weak, then if the country has to import, and this is what worries me about the US that a lot of people are not talking about, the US has to import lots of things. So if the dollar starts to get weak, commodity prices get high, those import costs are going to skyrocket.
Yes, absolutely right. And what happens is, there are narratives that are important out there. The technological advancements have created deflationary forces. You had money velocity as a deflationary force. You had, money velocity declining as a deflationary force. Aging population is also a deflationary force. But what trumps it all, who cares about all this? If you have commodity prices rising, it completely changes the game. And if you're telling me that I don't know about history, just ask anyone what happened during 73, 74. What created that problem was a commodity issue that began to rise and actually changed the cost of capital at that time, along with policies that we saw, such as the break of the gold standard. Does that sound familiar? So that's basically what we're seeing. While we see a lot of deflation, is what I like to call them intellectual, in parentheses, deflationists that are speaking with so much hubris about the situation about QE and money and money printing not being money printing, claiming they have full understanding of the monetary system, while I think they're missing a huge part of the picture here of the commodity shortage problem. I don't gain any money, arguing with people on social media about those cases. So I don't waste my time with that. I actually position myself accordingly. So we're long commodities. What can I say? I think that's the opportunity in the next 10 years. 10 years, by the way, it's a long-term trade. And for us, I think it's going to start sooner.
I've seen some Keynesians, neo-Keynesians, deflationistas, MMT people say that there's a savings glut now. But just because people have a little bit more savings, they're paying down credit card debt. I mean, there's way too much debt globally. Corporate debt, government debt. It's a Ponzi scheme at this point because the debt cannot mathematically be paid back. Everyone would be insolvent already without interest rates manipulated lower, and yet more debt's being issued. So all they're doing is just rolling over the existing debt that can't be paid back with large amounts of debt, thanks to the lower interest rates. And then the central bank balance sheets are going to keep increasing, probably larger than that 9.2 trillion number in 2020. I mean, I would not be shocked to see much larger numbers in the years to come, unless cash flow comes back into the real economy. And we're not seeing the politicians and the bureaucrats, especially here in the US and a lot of states, they're not allowing the economy to open. So those cash flows that are needed to either service debt or pay down debt, they're not coming back.
Yes, I think that the debt problem is a deflationary one at some point, but out in the savings is also an issue. But I have to say, the problem here is, like you just said, well, the economy is closed, number one, basically, for people that are not aware of this, and we've had transfer of wealth in the past in other places. Well, the majority of the population in Brazil is much lower classes, financially speaking, relative to the US. So what you see there is a lack of knowledge, unfortunately, about budgeting, financial spending, and all that. And the imprudence of financially speaking is what creates much higher levels of spending relative to even higher classes in categories in the society. What I mean by this is, when you have a wealth transfer happening also in the bottom 50%, which is a complete opposite from what we saw in '08, as I mentioned, 84% decline in net worth by the bottom 50%. Today, increased by the largest amount in history. I think that that's poised to create inflationary forces. It's poised to create consumer prices to rise. If you think that will be all saved and people are not going to be spending that money, you just don't know the history of the bottom 50%. Unfortunately, people are in the bottom 50% for a reason a lot of times. And they're, I'm speaking in a very generic way, obviously. Overall, it's because of being financially imprudent, along with other issues in the society as well, that I'm not going to get into that. There's certainly, inequality problems that we're seeing that also exacerbate that issue too. But along with a lot of things, I think there's a spending problem that usually occurs when you have your net worth increasing significantly. And what people are not realizing, or maybe they are, is that cash, it is trash. And at some point, spending capital will become something that may even start to really increase the value of things in general. And I think at some point people realize that the scenario here that is so positive for hard assets. And positioning wise, it's not like hard assets are completely out of balance and no one is seeing this trade. I think a lot of people agree with that, and perhaps we'll have sort of a sideways to downward move in the next months to kind of reprice and reposition the market for a bigger upside here. But focusing so much in the short term, which I completely agree. I mean, I think there's too many short dollar bats out there. I think there are too many bulls out there in the equity markets, and so it's prudent to, at least in our view, for us to have protections against that. Have shorts in our portfolio. We have long call options in the dollar relative to different currencies. I think that's all a very interesting trade paired along with hard assets.
Do you think this is the toughest time in your career to be a short? Because I've heard other shorts like Jim Chanos and others talk about this recently, along with Andrew Left and other famous short sellers. And they basically have said short selling is almost dead. You can selectively do it maybe for a short amount of time, but the old rules to doing shorting with fundamentals, those rules are dead now.
I have nothing good or bad to say about people like Andrew Left, but I think the short activists, as they like to call themselves, do create, it's part of the capitalism. It's part of the market to have someone, doing what they do, performing what they perform. And I think it's sad to, days like today when Citron, unfortunately is not going to be doing something they have been doing for the last 20 years, which is reporting and releasing names of their short positions. I think that served the market in a way, have some of those short positions gone against them. Yes. And that's part of the game. While, maybe they were wrong about it, or maybe their timing was wrong about it, so did I made a lot of mistakes on shorting things that have actually went higher, not lower. So it's part of the game. Now, removing that from the market and forcing them out of the market is a scary move. Now, what we're seeing is we're taking out some really smart guys that maybe have the wrong intentions. Who knows? I don't know about, like I said, I have nothing positive or negative to talk about them because I don't know them personally. But what I can say is that, I think there's a good intention in some of those that do believe that some of those companies are frauds, that do believe that some of those companies don't deserve to be where they are. And I believe what Jim Chanos says, that there has never been we are in an era of frauds today. I believe because that's, just the nature of how cheap money, is today. And obviously that will create problems like this. And, this whole situation about defund hedge funds and all that. Well, look, I'm in the hedge fund business, and obviously we're in a pretty different kind of setup than I think most other hedge funds that are being targeted today. But speaking for the industry, I also think that they have an important role in the financial markets, and so do retail investors as well. And is it wrong when if this conspiracy thoughts about if they have been changing the rules? Yeah, that's not right. I don't think anybody agrees with that. If they are changing the rules in order to win against Main Street, but what I think is I think it's important to have the two sides of the market. The shorts and the longs. That is what makes the market. Somebody that is pessimistic and somebody who's optimistic about something. You want to buy, I want to sell. And when you're removing one of them, you're going to exacerbate this speculative asset bubbles that we're seeing today. And I think the equity market is in a very, very dangerous spot. And yes, I've been saying this for a while. I have to say, my sentiment about this is at record highs right now. We are currently increasing our shorts because we are positioned, but I've never been so worried about all this.
Yeah, I agree. Historically, when the retail money who doesn't know anything about markets is this overconfident about how easy it is to buy call options or buy all these unprofitable companies that just keep going up with TikTok videos or Discord chat boards or Reddit boards or Instagram models posting about all their trading profits, who they don't even know anything about the company that they just bought. They just looked at the chart and said it's going up. So I bought high and sold higher. And I'm just reading about and seeing people just say all these things. This is like very, from a historical perspective, late cycle behavior. But what is happening now with the central banks and governments is unprecedented, though. They are basically destroying all the currencies. You said it's a competitive race to debase. It's not just the dollars printed. It's all these currencies are trying to devalue and prop up asset prices and bail out their banks and their large corporations and maintain asset prices with real estate stocks and bonds. So it's just creating an unbelievable amount of casino speculative behavior. And normally, historically, it's the retail money, because they don't know how to hedge. They don't take profits off the table, that is left as the bag holder. So the majority of the people who get screwed over when the party does end, when the game of musical chairs or hot potato ends, it's going to be the retail trader.
Oh yes, and that's the unfortunate part, and that was also the case during the global financial crisis, when they actually lost again 84% of their net worth, while all other classes of the society actually did significantly better than that. So now that's the sad part about all this, is that the way that they are actually trying to revolutionize this whole situation with easy money, zero interest rates, and so forth, is perhaps there's a better way to target all this. I don't know, maybe it is, for a lot of people, you appeals much easier the Bitcoin thesis. But personally, I think there's a lot of people looking at the new economy, forgetting about the old economy. But there is, in order to link the two, you need commodities, and I think there's a lot of people missing the point here. But to your point, look at the amount of overwhelming amount of get rich types of ads that we're seeing. I mean, I feel like I'm seeing an expert of option markets almost every day now on YouTube and other things that have been targeted as a possible client or so. And for me, that's just a huge sign of where we are today, a clear sign of where we are in the cycle. It's not the beginning of the cycle. For me, it's a very peak of the cycle right now. You can look at that by looking at valuations, and also, most importantly, sentiment and how the environment is so euphoric right now with equity markets. But at the same time, you see equity markets are actually going lower, not higher right now. And while we're seeing most of the focus on a few names in the market. So this is a very dangerous game in my view.
Yes, and look at the amount of SPACs, these special purpose asset companies. There's a small percentage that are actually viable. Most of them are unprofitable and just marketing scams. And then the amount of unprofitable companies and technology companies that are unprofitable, may never be profitable, that are going IPO, that are being dumped by angel investors and venture capitalists all the way through that chain there in the private markets onto publicly traded IPO markets to dump onto retail investors that will eventually crash. And you could just go on and on about all these bad companies that the shares are just going up, and no one cares about profits. No one cares about fundamentals. No one cares about earnings, because the share price is going up. But at some point, the party's going to end and the music's going to stop.
I agree. It's time to be cautious. It's time to be positioned, and it's also not the end of the world. There's a lot of really great opportunities coming out of all this. Like I said, when you mix the political environment, the macro environment, fundamental side of the industries, there's a lot of really interesting setups here that could end up doing really well in this macro environment right now. So. Again, for us, it's hard assets. For us, it's being short is that transfer of hyped overvalue stocks to or towards very undervalued, historically cheap hard assets such as gold and silver and some other related commodity plays. And so I think there's a lot of good things out of this as well, not only bad things. And I think that the Federal Reserve is hamstrung. I think that they are in the corner, and obviously monetary policy has clearly become a funding tool for the government. And I think we're only at the beginning of that. It's kind of like debt monetization 101.
The last argument where this is late cycle, before I end the interview and wrap things up, and thank you so much for your time today, Tavi. I've kept you for over an hour, so it's very appreciative. I've given my listeners a lot of great content, a lot of great analysis and information here. But we have corporate insiders. So there's enormous amounts of selling now of stock by corporate insiders, the large publicly traded companies, and the buybacks have started again. So that combination of things, of net insider selling of corporate insiders with their own money, and then using shareholder funds instead of paying down debt on the balance sheet, using them for buybacks again, that to me says that they're worried about their stock price. They're dumping it with their own money. And that's more late cycle behavior as well, of possibly a stock market top.
Yeah, it goes back to, they're the first ones to get out. And while most people are thinking hedge funds are stupid, I think they're probably the going to end up being the smart ones again. Unfortunately or fortunately, it's just how the game works in this business. Is people get really positive at the wrong times of the market, and we start seeing these crowded ideas all along, and that's the time when you need to be concerned. Even back in July, I was hearing a lot of people talking about silver, for instance, at the time when silver was going up, it was almost parabolic at some point. And even those markets get frothy at periods, and not right now, but at sometimes they do, and they will get caught up in some of those sell-offs, I think, in the next in the next months or so. But the opportunity is so big for the following years that my goal at least is to be accumulating our positions as much as we can and continue to raise capital to deploy into this industry. But yeah, unfortunately, insiders and all that. Those are the first ones to jump out of those trades, and and they cover themselves up by doing those buybacks, and that's pretty common, as we all seen. And unfortunately, retail investors are trying to prove a point here in another way that might not end up well, in my view.
Well, I want to thank you again for your time today, Tavi. I will attach links to your Twitter feed, which I think is a must follow. Amazing charts for free. And then also I'll put a link there for your new quarterly investor newsletter from Q4 2020 that came out on January 28th, 2021, yesterday, because this interview is recorded on Friday, January 29th.
All right. It was my pleasure, Jason. Thanks for having me, and look forward to talking to you again